All right. All right, fellas, look, every chart, every strategy, every setup, it all comes down to one thing. The market either breaks, it bounces, or it sweeps. I don't care if you're a fib trader, if you're a moving average trader, it doesn't matter, right? It's either going to get to where you want it to, break, bounce, or sweep. Everything we do, from your entries to your exits to timing, even psychology, exists to identify which one is happening right now so we can take advantage of it. So what we're going to be talking about today is the Tactical Edge Bible. This is a document that 6 documents that we have put together, and it's the holy Bible of trading from its most basic and primal standpoint. And that's what we're going to talk about. And this is going to take as many podcasts as it take, but this is the framework to success. This is the framework to be a trader and take trades. Where do you enter? How do you exit? What kind of trade are we taking? How do you chart? So here's a question that I've been getting asked a lot lately. Is someone asked me yesterday, they said, all right, what is the thin line between, you both have seen those like meme charts of traders, right? Where there's like a million lines and there's indicators everywhere. And what's the line between that and levels? Like what's too much? What's too little? What matters from a price standpoint and why? And we're going to break this down to its most primal form. So let's start here. So let's start with why. First of all, why are we marking out levels on a chart, Brian? Just basic shit. Basic, from a most basic level, why are we marking stuff out on a chart?
Why are we marking stuff out on a chart? Well,
why do we put a trend line?
I am... As a technical analyst, I am looking for an advantage. And so my lines are based on gaining a technical advantage, whether that be support, resistance, liquidity. So those lines are based on historical things where I know that there's going to be a reaction, and that reaction can give me an advantage on the competition.
Yep, 100%. That's it, right? From its most basic level, it's to see where price is reacting, where it's reacted in the past. And hopefully, right, based off of that structure and your highs and your lows and your liquidity and all that stuff, where price might be headed next. Where's the liquidity? And I think this is about reading the market like a map and not predicting it, right? Dunki, why does TA work?
Because everyone's looking at the same levels.
Yeah. It's simply self-fulfilling prophecy, right? Yep. I mean, it's if everyone's looking at the same thing, people are going to react there. But also, the more people that look at that same thing, the more people that are reacting there, right? There are some oddball indicators and some oddball tools on TradingView that not a lot of people use, right? And so you might not be as strong as a level. But Brian, what does everyone use? No matter what kind of trader you are.
What does everyone use? I'd say everyone uses trend lines.
Yeah, trend lines. That's what everyone uses. It doesn't matter what kind of trader you are, right? You could be a Fibonacci trader. You could be a Bollinger Band or Elliott Wave Theory or whatever. Like, what are Elliott Waves based off of, right? Swing highs, swing lows. What is anything based off of? What are indicators based off? What are divergences based off of? Swing highs, swing lows, market structure, right? So I think the first thing that I want to attack today, and here's what someone asked me the other day. They said, what matters, right? What matters from a price standpoint? Well, we're going to talk about that today. So let me go ahead and throw this up. Price structure, liquidity. Let's get this on the screen here. So what lines matter? What lines don't matter on a chart? Is there such a thing as too many lines? Well, yes. The answer is yes. We've all seen it,
bro.
Yeah, look, we make fun of crypto face. Brian, throw on your wig, dude. Come on. We make fun of crypto face spider lines, right? Because there's a million lines on his chart. And of course, if you have a million lines on your chart, one of them is going to get hit. So then the question comes down to what matters, right? What lines matter? And I think we can probably all agree here that you start maybe monthly, but really the weekly time frame, right? And why do we start at the weekly? It's the macro bias. And I think we can all agree to these things, right? What are we looking for on the weekly time frame, Nick?
Structure, highs and lows.
Structure and highs and lows. So here's all I'm charting when I pull up my, and I'm going to show you. So let me go ahead and share my screen. Very simple. Weekly time frame. What am I marking out? I am marking out this week's high and low and last week's high and low. So there's last week's. I'm going to do an Alt-J, Alt-J. Same thing. This week's high and low. Boom, boom. Right? And then I'm going to do other structure, like maybe the all-time high since we're up there. There's a high. I'm going to look for diagonals. I see a big old diagonal here. Boom. I'm not going to draw these perfectly, but you get the point. 5 levels. Right? Is there more than 5 levels? Sometimes, sure. Is there levels below and above us? Sure. But guess what? We're not yet down here. So I don't care what happens down there. I only care about these 5 levels because those are the 5 levels. Those are the battle lines. That's the battlefield that we're dealing with right now. You guys agree with that?
Agreed.
Yeah. It gives you macro bias too. It's easy to zoom out on a weekly chart and see where you're at in the structure, right? We can see we've been pumping, flag, pumping, a little bit of a dump, but that created this trend line, right? Pumping, flag, pumping, flag. We're in pretty good shape until we're not, right? So you can see if we lose that, probably bad. You can go back here and see how that looks in the bear market. Look at this, whole bear market. We break that and then we're off to the bull market. Oversimplifying it a little bit there for
Or break
entertainment
that and we're off to the
purposes,
bear
but
market.
what's that?
Or break it and off to the bear market.
Yeah, maybe. Maybe. But keep it simple. You don't need to mark out every single tiny little thing. What levels matter? Major swing highs, major swing lows, weekly opens, weekly close. Why do you think current week open and close matters, Brian?
Current weekly, I was going to ask you that. The weekly, yeah.
Yeah, so a couple reasons. It gives bias for structure shifts and liquidity targets and expansion and contraction targets. So when we mark out the weekly candle on a Monday, what does that encompass, Dunki?
When you work the open of the week.
Yeah.
So where
Well,
either buyers or sellers stepped in to potentially change the direction for the week.
Weekend
Bias
liquidity too, right?
Yeah.
When we sit down on a Monday, it's marking out weekend liquidity, which we often come back for. When you mark out a weekly candle, there's liquidity living there above the tops, above the bottoms. Everything that happens within a weekly candle, so daily time frame, hour, 5 minute, is just reacting to the weekly chart. Going towards the extremes, going towards last week, grabbing the lows, grabbing the highs, and then it gives us expansion and contraction targets, right? So if we take out the weekly high and the buyers step in, we're going up. If we lose the weekly low and the sellers are still at it, we're going down. That's it. Those are the levels that I want people. Now, can you deviate from this once you figure out like the most basic of shit? Sure. Right? Once you can handle the basics, can you add on other layers? Absolutely. But until you can get the most basics, right, which is major diagonals, major swing highs, major swing lows. I'm going to share this again. Right, trend lines off of extremes, most touches without cutting through candles, major horizontals, highs and lows, current week open close, previous week open. Until you can figure out this, which is just the most basic, don't do anything else. These are the walls of the market, the macro liquidity zones where the big players are positioned. Everything smaller, daily and intraday reacts to these. And it gives you directional bias, like I said, expanding, ranging, or reverting. And then guess what? What's our next stop? The daily. The daily is the liquidity map. And it's the same thing. Mark out the previous day's high and low. Mark out major daily swings and lows, key consolidation zones. And if you want, overlay the fixed range tool. And if you want to add in some anchored VWAPs here, feel free to do that. But this is for your local ranges and auctions. Now, the daily matters because it's short-term liquidity magnets. Institutions hunt these. What do we target? What are our targets? Like when we sit down in the morning and we get out our daily levels and get out our weekly levels, what's our next stop?
Session sweeps.
Yep, session sweeps, and that's daily levels. Where does Asia start, right? That's the daily candle start. So these are short-term liquidity magnets. And institutions, we see this all the time. Institutions, big players in the market are going to hunt these for stop runs and reversals. Now, why would we mark out the previous day's high and low? Because they're the most targeted liquidity pools in all of crypto, especially around New York Open, right? Where we target them, sweep them, and we pivot. Now, we can pivot one way or the other. We could take it out, buyers step in, and we're off to the races, right? Where we expand, or we could contract. We could lose the low, and we're off to the races on the next target, right? Typically, when you're chopping within the previous day's candle, it's a chop day, right? When you take out the high or the low, it's an expansion. Or is contraction the right word? If it's the opposite of this, I guess it'd be expansion to the downside, right?
Yep.
Yeah. I don't know if contraction is the right word, but you know what I'm trying to say. Yeah. So I think, look, everything that I'm mentioning right now is super simple to do. And it's what's that?
It's the building blocks of the basics.
Yep. It's the absolute basics. And literally, it's what I trade, right? It's what we trade. They're the levels that we trade. Highs, lows, swing highs, swing lows, right? These are daily and weekly levels right here because there's no difference between the daily chart right now and the weekly chart. Mark them out. Yesterday's high, yesterday's close, both for the weekly and the daily. And then swing highs, swing lows, and any trends that you see. That's it. Now, we can drop down into the 1 hour, and this is where intraday traders should live, I think. That is an opinion. Just because I say something doesn't mean it's right. I mean, do you guys agree with that? Like intraday traders should be living on the hour chart?
Yeah, hour 15.
I like
a derivative of the hour chart.
I like the 30-minute.
Yes.
My preference over time is it's not too noisy, and it's not too late. Right? It keeps me calm being on the 30-minute. When I'm zoomed in and I'm looking at a 5-minute or 3-minute, I'm like, oh my God, I missed the move. When I zoom out and I look at a 30-minute candle, I'm like, okay, calm down, guy.
Yeah, I
Every
think it's
wiggle looks
important.
different on the 5.
Yeah. I think it's important. Look, your middle time frames are for structure and control, right? It's what do you mark here on the hourly chart? Well, you mark your active range, right? Recent swing high, recent swing low. Your short-term trend line guiding structure, 1 hour swing points. It's the same thing. You're marking out the same things. You wouldn't mark out like the hour high and the hour low, but everything else is the same, right? You would mark out your swings. You would mark out any liquidity pools, just 1 hour swing points, right? The 1 hour chart, I think, or 30-minute, 90-minute, 2 hour, whatever you're comfortable. Pick one though, right? Pick one. And if you don't have one, pick the hour. Start there. Especially if you're newer, because the lower you go, the more noisier it gets. If this is your like battlefield view, it shows you the battle. Local diagonals, right? Short-term trend lines that guide structure. 1 hour swing points that align maybe with VWAP or session highs, session lows, because they often do. And after this, I think you don't mark anything out unless it's a session liquidity. So on a 15-minute chart, so I think people, and we'll talk about this in a little bit, but people trade these charts and don't execute on these charts. So does that make sense? People will execute, they'll trade them but not execute. Like I'm trading the 1 hour chart, but I'm executing on the 15 or the 5. I'm not trading the 5-minute. I think that's where most people mess up.
Yep.
So what do you mark on a 15-minute heart? Your session liquidity, your London high and low, New York high and low, Tokyo session range, micro trend lines, right? Maybe you got a little 15-minute diagonal to frame the intraday flow. And then any little reaction zones where maybe VWAP crosses the liquidity edges, right? Maybe VWAP is lining up with like London high or London low or something like that. These smaller time frames are where the trades are made. It's the entry time frame. Session highs and session lows are intraday liquidity magnets here. 5-minute, just like precision, like sniper entries, right? looking for bounces off of VWAP or overtaking VWAP or sweeping something. Obviously, deviation bands are optional here. Price almost always stays in 2 standard deviations of VWAP. I think like 95% of the time, 90 or 95% of the time. And why do we do all this stuff, right? Why do we mark in here? I'm going to show you what my chart looks like from today. So I have my weekly levels, boom. I have my daily levels, which is just 2 daily swings. So we have, oops, I'm not even showing that on screen.
You're not, sir.
Thanks, guys.
I thought maybe there was a lag, but as soon as it didn't come up in like 3 seconds, we were good.
So I'll start over. Got weekly levels, right? Same that I drew before. Toss on my daily chart, daily swing. I mean, this is strong, right? So you got 2 closes, wick, lost it, retested it, 2 closes in the same spot. We had 2 closes there. I'm going to throw a trend line there, right? I did put a question mark by it when I labeled it support daily, because I'm not sure it's like a super, super strong level. It's not a big swing, but it is a level because there was nothing in between the weekly low and last week's low. It was just a big void. So I'm trying to find a potential spot in there where we could bounce. And it's these 2 daily levels. Otherwise, it's just last week's low or this diagonal trend line. That's it. That's my daily and weekly chart. It's not 50 trend lines. It's 5 of them or 6. 1, 2, 3, 4, 5, 6 trend lines. That's it. And they're all based off of the daily and weekly levels. Strong. This is what I'm trading. Then I'll drop down into the hour and see if I see anything different. Now, before I had these daily levels on there, here's what I didn't like. This. Like, what do? I'm just going to react. Like, which one matters here? That's the question people ask, right? Is which one of these matters? There's a bunch of 1 hour swings here. Well, when I get confused like that, and I can't really, like, I'm not going to just guess, right? I'm going to go back to the higher time frame. I'm going to go back to the daily, and that's where I drew in those 2 swings. There and there. And I'm just not interested in here. I'm not interested in the in-betweens, man. I'm just not. Because traps live there, and I'm just going to give money to the market. And then local levels are just sessions. That's it. Tokyo high, London high, New York high, if it puts in a new high for the day. Those are the levels that matter. Do you guys agree? Would you add anything else here? And here, let me tell you this. I'm gonna take it a step further. Anything else that you do on a chart adds confluence to these levels. And I think, and just because I say something doesn't mean I'm right, I'm open to debate. I think everything else just adds confluence to these. So I think that if you're going to draw a fib level and it lines up with your daily support or your weekly level, that just makes it stronger. I think if you're drawing an anchored VWAP, for example, I'm probably not going to, for me, and Brian, you might actually think differently here. For me, I'm not just trading an anchored VWAP in the middle of nowhere. And I don't know if what you maybe answer this, but I want it to line up with something. Right? A swing high, a swing low, some trend line, and then I'll trade it because that's just adding confluence. And I don't know if you feel this. I don't really trade anchored VWAPs. I just use them for confluence.
I mean, context is everything, but always, some kind of confluence, right? It was like yesterday. We had that, price was diving and we had a nice anchored VWAP that lined right up on the top side of the triangle trend line that we broke. And we found support there. I mean, we eventually lost that support, but there was multiple layers on top of that. So multiple layers is always nice as far as like taking a trade. That's what you want, right?
Mm-hmm.
You want, because like Dunki was saying, right, it's a self-fulfilling prophecy. Some people are looking at anchored VWAPs. Some people are looking at fibs. Some people are playing horizontals. Find out where they're all playing it together.
Yes.
Yeah.
Yes. And I think that's the most important takeaway that I want people to have from this specific section is the more things you have pointing towards an area, the better. I mean, that's why sometimes people will come to the same level using different things, right? That's what we want. And it's like going back to what I said at the beginning, if trading is also self-fulfilled prophecy. The more eyes on something, the stronger the reaction is going to be. Whatever the reaction is. Remember we said, break, bounce, or sweep. We haven't gotten to that point yet, and we will. But one of those three is going to happen there. And if more eyes are there, more people are going to be hitting long or short or buy or sell. So yeah, I mean, if you have a golden pocket lining up with a weekly low, lining up with an anchored VWAP, with a Bollinger Band or whatever else, an Elliott Wave, swing, it's strong. Everybody's watching that area. It's going to get a reaction one way or the other. It's our job to figure out which way, or make an educated guess, I should say.
Yeah.
But yeah, I agree 100%.
I think that, like you're saying, horizontals are probably the strongest levels because they're undeniable, right? I mean,
Yeah.
it's like that's where the weekly resistance, the weekly support. Something like a fib, it's more of a technical tool. So, but those horizontals are definitely the bread and butter of fundamentals of technical analysis.
Yeah, it's where liquidity lives, and it's if price is always going to or creating liquidity, it's always making or taking liquidity, right? So when you can draw a horizontal or a diagonal in some cases, right above it lives liquidity. There's stop losses right above it. People who are watching, and everyone watches diagonals and horizontals, probably more so horizontals and diagonals, but people are going to react there because everyone's watching it. So you got not only structural liquidity sitting there, right? Stop losses. People are going to react to it. It's a big magnet. Cool. Let's go on to the next one. So the next one, we'll probably won't spend a whole lot of time on this one because it's pretty simple to understand, I think. Oh, let's see. The clock. We're going to talk about the clock today. Oh, actually, the clock's next. So we're going to talk about, this is kind of the clock too. So just keep in mind, like this stuff is like the foundation of trading. This is, if you don't understand this stuff, you're not going to understand anything. If you can't do this stuff, you're not going to be able to do anything. So I want to talk about the time frames, right? I think for most people, I think, like Brian, I know you say you like the 30-minute. I don't know that I would tell a brand new trader to form your bias off the 30-minute. I think Brian's a killer. Brian's been doing this for a while. He can live in the 30-minute. I would say that if you want to be like a scalper or like an intraday trader, start with the hour. Can you change later on? Yes, right? But from a beginning standpoint, let the 1 hour be your battlefield. Let the 1 hour define the war zone, right? It's this middle time frame that defines the battlefield, right? The lower time frames are just execution strikes if necessary. And Dunki, do you need both of you guys? Like I already know this answer. Neither of you need a 15-minute or a 5-minute chart to probably enter. If they didn't exist, you would be just fine on the hour, right, Brian?
If they didn't exist, I guess I wouldn't need it because I don't have it. One thing that I think is very important is before you're going to define the war zone, you have to define what kind of soldier you are. Are you a position trader? Are you a long-term trader? Are you an investor? Or are you a scalper? Defining what you are in the market is key. And that goes through your personality, right? Like me, I am an emotional dude, right? And I don't like to make quick decisions. I like to sit with my menu and look around at all the other tables and see what everyone else is eating. I like to think about it for a while. So I'm more of a swing trader. And so then I need to take a wider outlook of the market to see where it's going, right? I think if you look at it on the weekly, I was having a conversation in the group about somebody, and I said, yeah, but if we zoom on out here to the weekly, and they were like, oh my God, I never even thought to zoom on out and see where price is going on a higher time frame. And it's like, yeah, it's very useful knowing what you are in this game.
Yeah, if you have a 9-to-5 job, you probably don't live in a 5-minute chart, right? Yes, so I'll talk about that. Yep. So I think if you are intraday trading, though, and that doesn't mean scalper, but if you're just catching the move of the day, or logging in for New York Open and trying to catch a move or whatever, Asia session, right? The 1 hour is your battlefield. And I think this is where you fight your war. It gives you real structure, the rhythm of liquidity. It gives you volume. It gives you momentum shifts that define your week's opportunity. Remember, we're trading within a week. That's why we start at the weekly time frame and work our way down. But this is where you plot your battles, right? Your support and resistance is typically clear here. Diagonals, Liquidity pools live here. We're just trading from pool to pool to hopefully work towards that weekly liquidity and above and beyond. This is where you decide where the market is likely to attack next. It's the perfect blend for clarity, for reaction speed. It's high enough to cut the noise out, but it's low enough to respond in real time. And it shows you where the real fight for control is. Now, the 15-minute is like your tactical map. This is where you plan your strike. Now, the 15-minute chart gives you pretty good entry structure. It gives you pretty good confirmation logic. You see liquidity sweeps here. You see market structure shifts. You see volume confirmation pretty damn cleanly here. It's where you refine your 1 hour thesis into a trade idea. This is your mission planning chart. It's not too fast. It's not too slow. You can spot timing. You can spot alignment, and then even failure patterns like SFPs that are developing here. So the 15-minute defines execution zones inside your war. Now, when we start dropping below this, these are, I think, optional. And this is what I talked about earlier, where most people mess these lower time frames up. Call the 5-minute the knife fight, right? This is where you execute precision strikes, but only if your style requires it, like Brian was saying. Most people should not be in a 5-minute chart. I'm just putting that out there. If you're trading SFPs, if you're trading liquidity grabs or quick scalps, the 5-minute can give you micro confirmation of like a wick trap or some kind of structure reclaim. Maybe you can see some volume or momentum mismatches, whatever you use, OBV, MACD, RSI. And you can get some pretty good stop placements too with microstructure and tighter risk control, right, for your entries. But there's a lot of nuance around the 5-minute chart and the 1 minute and anything really 15-minute and below. You don't need the 5-minute if your 15-minute gives you confirmation. You agree, Brian?
Yes.
Yeah. The 5-minute is only there to refine your entry. The 5-minute is not there to refine your direction. The 5-minute chart should not talk you out of like a good 15-minute and an hour trade. Like if you got the 15-minute lining up with the hour and everything's screaming, like you can't miss, like a 5-minute chart should not talk you out of that trade. And I think this is where a lot of people...
Where accounts go to die, man. It's the graveyard.
Yeah.
You just get stuck in the 5-minute. You're there all day, not looking at any other levels but the 5-minute.
Yep. Most traders blow accounts trying to trade the 5-minute instead of trying to execute on the 5-minute. I've seen people get talked out of good trades because the 5-minute said it wasn't a good trade, and then the 15-minute and the hour does. It's like people are they're trading the 5-minute where you should be executing on the 5-minute. And it's the same thing with the 1 minute. We have to talk about the 1 minute because we talk about the 1 minute chart when we're trading, right? So I think you can glance at it when you're sniping like very small microstructure shifts and very specific SFP setups, right? I think this is danger territory. It's confirmation, not conviction. It's where you enter only if every other time frame has aligned. So hour, 15, 5 line up, you're looking for that sniper entry on the minute. You've already got your plan. The hour already says go, 15 minutes says go, 5 says go. Why not flip down to the minute? There's been instances where that has happened for me, where I've seen the hour, the 15, the 5 line up, but I'm just a little shaky for some reason. And so I'm waiting for a 1 minute structure shift on like an SFP to rebound or something. You know what I mean? Or a break back into a range. And that's like the
there's
final...
actually a pretty good example on the Bitcoin chart right now on the 15.
Show it.
Green. So here, we're breaking back into, on the 15-minute chart, and we're breaking back into our previous range, right? We broke structure all the way down this morning. We took liquidity bottom, swept the whole thing, and now we're breaking back up towards range low, or range deviation. But that's what we're always looking for. We're looking for the structure shifts. We're looking for liquidity to be built. Here's what resistance, and then pop, right? What did we do last time? This morning? Resistance, and then failure, right? So all day, every day. Today's a unique day based on the FOMC stuff, but it all rhymes, man.
No. Can you unshare that?
Yes, I can. Give me 1 second. Stop. There we go.
Share mine again. Cool. So just to end this one, I think the 1 hour shows you the war. The 15-minute gives you the plan. The 5-minute pulls the trigger if you earned it. If you understand this hierarchy, you'll never get lost in noise. It will never say never. But but it'll be a little bit cleaner. The 5 minute and 1 minute are tools for precision, not prediction. The real work happens on the hour, the 15 minute, where liquidity and conviction meet. And then, to Brian's point, this can be applied to any trading style. Swing trading higher time frames, daily 4 hour an hour.
I'm about to show you the hour there. It did sweep the hour low for the context.
Are you doing macro analysis? How about the weekly, daily, and the 4 hour, and so on and so forth? You can build this same structure around any type of trader you are. Back to the question I asked earlier, like, if I'm a swing trader, and I'm looking for the bigger, longer trades and bigger, longer swings, do I need a 5 minute chart? I don't think so. I can get the same trade on an hour, on a 4 hour.
Yeah.
I can get that. It's going to, for how I trade, I want to see it sweep a level, reclaim the level, and I'm entering. I can see that on a 1 minute chart. I can see that on a 4 hour chart. I can see that on a daily chart, right? I can see it come down to my level, wick below it, and go back above on any time frame. I think, and I'm not saying you have to or don't have to do it that way. I'm just saying you don't need it, right? You don't need the 1 minute. You don't need the 5 minute. If you're a swing trader, go to higher time frames, right? Build your biases on the daily, the 4 hour, the 1 hour. Are you a macro trader, right? Like bigger trends? Are you looking for market tops, market bottoms? Are you looking for cycles? Weekly, daily, 4 hour. You agree with that, Brian? You're muted. You're muted.
Sorry about that. Yes, I do agree.
So cool. All right. We're going to go to the next one, which is, this one's the clock. So here we're going to talk about sessions. Here we're going to talk about days of the week even, because this is all important stuff. I mean, this is stuff that I do every single day. I did it today, right? I was trying to build my frame of reference and my context for the trading day today. And so what did I do? I looked at the last couple of FOMC meetings. I looked at the last couple of FOMC days to see what they did. And then I looked at the week and I looked at what day we're in, and I'm building my frame of reference for the trading day.
Yeah. And just to plug it quick, we do this live for the members in Discord and the premium.
Every day.
Every New York
single
session.
freaking day.
Yeah.
Even on the days where I have to sit in my warm ass bed, dude, and I'm talking to my inner bitch for like 20 or 30 minutes. Like, I'm just going to text them that I'm just not showing up today.
Yeah.
And guess what? I still fucking show up, dude.
You know what? You're already sitting in a trade that's up 120%. And you're like, fuck.
That was me on whatever
That was
day.
me all week until yesterday where I closed it.
Yeah. But still, man, that's discipline. That's discipline. I don't need to show up every fucking day. Trust me, I don't. I do not need to show up every single day. But I do, to build that discipline.
Habit. Yep.
The habit. Right.
The second
so
you stop doing it, man, you start getting weaker. So
Exactly. It's the same thing with me in the fucking gym, dude, or me in fucking working out, or me in anything. Like, the second, like going on vacation, fucked me from working out, right?
yeah, drop and screws up the habit, and then you're
Yep.
like, okay, I don't even want to go now.
Yep. Then I got to build the habit again.
Yep.
Let's talk
Staying
time
busy.
element. Let's talk sessions. This is very generally speaking, by the way. And everything that we're talking about today, just so everyone knows, it's generally speaking. And what I mean by that is probability-wise, it all happens more often than it doesn't. Does that mean there are not exceptions to the rule? No.
Exceptions to every rule.
There's
Everything we
exceptions to
say, there's an
every...
exception to.
Yeah. We're not trading the exceptions. We're trading the probabilities.
Yeah.
So...
And let's, before you hop into that, why, like, never mind, go ahead. I'll
go
catch
ahead.
you at a
What?
better time. I was
All
going
right.
to say, like, when we talk about taking these things, you know, when we do it from a New York Live standpoint, we're looking for 1 or 2 trades and we're wrapping it up for the day and we just reset for the next day.
Yep.
Right? Because it's all, we were talking about probabilities, and this is what made me think of it is every time you roll the probability dice, you have a probability of winning or losing. But in the morning, when you do your levels like this and you set your day up like this, you increase the probability to win that first and second trade because it's the best setup of the day. You've already done the levels. It's coming into the highest volume portion of the day. Just stop. Because if you keep rolling the dice, eventually you're going to lose and give back.
You know, that's one of the cool things that I love about this place too, is that, and one of the coolest things that I learned here was that we are live when it counts. A lot of times, like, you know, Eddie's also doing live trading Asia session. He knows how Asia moves. Every market has a personality, but really, like, for example, if we don't take a significant high on New York, like if we do it like in the middle of the night for me, London market, you, Ben, would probably wake up and say, well, I mean, New York is probably just going to take that out because it can, right? It is the biggest market. So having these different markets in trading, like Dunki was saying, when it counts, like from 9 a.m. to 12, it's go time. And then usually after lunch in the New York session, it's lower volume.
Yep.
That's one of the coolest things that I learned here that I love that we focus on is we are live trading this
When the
it-
time counts.
when it matters.
That's what we're getting into now.
Yeah. And look, if the price is what, right, and the volume is who, then the time is when, right? So that's what we're talking about now is the when. And this is generally speaking, as we said, Asia typically builds the range. London usually sweeps the range. New York usually, a couple behaviors, but it sweeps everything, right? It expands or reverses the move. You guys agree with that?
Yeah.
Not only that,
Generally.
I think that everyone should, every new trader should screenshot that and be aware of that. That's like
So-
years of hard learning right there can be summed up just screenshotting that and just knowing it.
Yeah, so we've been doing an accountability stuff in Discord and breaking down people's trades every Wednesday and Saturday and Sunday, right? And there's been a common theme. That common theme is a lot of people are holding trades during Asia session. So there was just one the other day. I won't mention the name. There's actually been a bunch of them, but they'll enter a trade during Asia. They'll go to sleep and they're surprised when they wake up stomped out. And here's my question to them, right? Here's my question to them is, what are we looking for every morning in New York session? What's the move that we're looking for?
Sweep of the Asia session.
A sweep of the
Completely.
Asia session. So why are you surprised when you're holding a trade overnight that you get swept?
Yeah.
Take your profits, man. Asia is not, generally speaking, right, for swing trading. Sometimes is there a really good entry during Asia? Yes, I'm not. But more often than not, it's just ranging, right? Just going up above VWAP, below VWAP, up. Take your little scalps, right, during Asia session. And yes, if it comes to some kind of major swing level and you got good entry confirmation, take it, right? I'm talking about the standard and not the exception, though. But yeah, volume happens during New York, right? And the Asia and London overlap too. There's some decent volume there, about 2-3 o'clock in the morning for us in the U.S. There's some liquidity there too.
Yeah,
Mondays, false move Mondays, right? And again, this is very generally speaking. This is your range setting day. This establishes the week's high and low and boundaries. With crypto, Sunday technically establishes the highs and lows, but with stocks, it's Monday. Usually a little bit lower volume on Mondays compared to the rest of the week, especially Tuesdays and Wednesdays. There's thinner liquidity. Why do you think that is? Think about it, right? Nobody's positioned yet. It's Monday. You know, these hedge funds, they don't work on Saturdays. They're on their yachts, doing Lord knows what, but they're not working on Saturday and Sundays. They're spending their billions. Monday rolls around and they start thinking about positioning. So there's thinner liquidity on the books. There's lower volume on Mondays. Doesn't mean there's no volume or low volume. I'm saying lower volume. Institutions are starting to position here, not necessarily commit yet. Retail often gets baited into early moves on Mondays. This is why we call it false move Mondays. And that's in every market. It's false move Mondays. And that false move usually reverses either the same day or on Tuesday. And sometimes there's a false move in both directions to grab what usually,
What does
guys?
it do? It closes the Friday gaps on
Yep.
CME and grabs crypto weekend liquidity.
Yep.
For the bounce or the dump.
Yep. 100%. So sometimes if we open up and there's a gap below us, what will they do? They'll wick up,
Take
fake everyone out,
liquidity and close
turn
the
it
gap.
around, close that gap, and then we're going back up.
Right back where we came from.
Double whammy, right?
Yep.
That's why Mondays are called false move Mondays. Again, more often than not every Monday, but most Mondays are false move Mondays. This is great for mapping liquidity zones. It's really bad for aggressive trading. If you are a FOMOer, a revenge trader, if you're a 10 trade day kind of guy, you might want to stick to other days of the week and not Monday. I think Monday is good for being patient. It's good for spotting and trading the traps. If you're really
good for planning your week.
Yep. If you're really good at trading traps, Monday can be a killer day. If you're really good at spotting the traps and you know how Mondays operate and you know where the liquidity is and how we react to weekend liquidity and session liquidity, it can be a killer. It can be it can be your best day of the week if you're really good at spotting traps. Now, Tuesday is usually the expansion or the true move day, they call it. Volume increases as institutional flow now here is in full swing post-weekend. Often the true directional move of the week emerges here. Smart money uses Monday's trap to fuel the expansion, right? So Monday sets the trap. Tuesday uses that to fuel the expansion. It's the strongest trending day statistically. Statistically, it is the biggest day of the week for indexes and for Bitcoin. And obviously altcoins as a byproduct of Bitcoin. Trend confirmation day, follow structure and volume alignment. And you can see that. I mean, you can backtest this. Go look at what happened last Tuesday, right? Last Tuesday was the big move up, the big move down. It was the biggest move of the week.
Yep. You define the range for the rest of the week.
Yep. 100%. Wednesdays can either be like midweek continuation or a trap. This is the pivot day. You're either going to confirm intent or unwind. There's two primary behaviors on Wednesday. It's either continuation. So if Monday's move had conviction, we're going to continue, right? Volume plus momentum are aligned. We're going to continue. Wednesday just extends Tuesday. However, if Tuesday's move was overextended, like it was last week, or it was extended and it was emotional because it was based off of news. Both happened on that day. And then what happened? We faded it. We faded the whole thing. And this is a lot of times timed with data releases, CPI, FOMC, like today, oil inventories, if you're trading oil, stuff like that.
Yep.
So think,
in general.
Yeah. Yep. Wednesday decides that the move is real. Trade continuation only with confirmation. Spot and trade the traps as always. Wednesday confirms the trend or pushes the crowd that chased Tuesday. I think Thursday and Friday are pretty big days. Thursday is either a reversal or a liquidity rotation. This is a pretty common profit-taking day because price has already moved, right? Tuesday, Monday, Tuesday, Wednesday. This is a common profit-taking or counter-move day. Liquidity from early week positions is now ripe for the harvesting. Especially it can be a strong reversal day when Thursday sweeps the weekly high or low set earlier. So if we sweep the weekly high or low set earlier, it's an especially strong reversal day. And this on the stocks aligns with options flow and positioning ahead of Friday expiry and profit taking. So Thursdays, you should be thinking reversal setups, liquidity sweeps, market structure shifts. Thursday is the assassin. It hunts the week's extremes. And Friday is just an unwind. It's just a volatility. Like it fades volatility, right? Traders flatten risk into the weekend. Intraday volatility spikes early, especially into New York Open, then fade into close. Pretty good mean reversion day. It's pretty good for fading setups or closing existing trades and just getting out and taking your profits. I think you should be thinking on Friday, fade the move. Fade the move. It'll move in the beginning of the day, and then it kind of fades after lunch as people are just closing out trades, man. And I think Friday's job is not to make you rich. It's to protect what you've earned that week.
Yeah, and the fade is either direction. It's not fading up or fading down. It's fading the direction.
Yeah, so if it's been up, right, the fade is down because those positions are closing. If it's been down, right, the fade is up because those positions are closing. Obviously, the shorts won that week. What do you think about weekends, Brian? What's your sentiment and thoughts around trading weekends and weekend liquidity?
I just don't anymore.
Same. I just close it up.
I used to, but I just don't. You said one day, you said, but when you first told me, you're like, rich people aren't trading on the weekends. They're enjoying their life. And you got to have some time away from the charts. Mm-hmm. And so if you're doing this and you're staring at a chart every day, it's useful to me now to not do that. It lets my brain process the week. It gives me a break, right? If I had a good week, if I had a bad week, it just gives me a chance to step away and process. So I don't trade on the weekends just for my sanity, because is this a job or am I just addicted to trading, right? And weekends are very unpredictable. So I lose my
they're
advantage.
slow,
So
usually.
with lower participants, it's going to come a higher level of unpredictable, just volatility.
Shenanigans.
Yeah. So I got less of a chance on the weekend, and it just, after a while, it was like, all right, I'm not doing this on the weekend because I'm seeking profit. I'm just seeking to fill some kind of void. I'm just gambling.
Yeah, I agree 100%. I think it's a good way to give back your profits during the week, getting caught up in the weekend.
Yes.
Fed just cut rates by 0.25 bip.
So let's talk about some common mistakes. I don't think we're going to cover another sheet today. We've gotten halfway through this. We'll do the rest next time.
Yeah.
But let's kind of go into some discussions, some topics here. Common mistakes, right? Drawing random lines not anchored to swings or value. What do you guys say there? You've
Random
seen it.
lines don't mean anything.
You've seen random lines on charts, right? You've seen. This is what I'm trying to teach Bobby right now: is what lines matter, what lines don't matter, right? And I've seen the charts, man. I've seen the charts with lines everywhere, and I'm just trying to figure out what people are doing. It's like they're marking out every 5-minute little tiny blip, and like every daily candle. Like if we have like an upswing, right, and there's 6 daily candles creating that upswing, they got a line on the bottom of every daily candle. So now all of a sudden your chart looks like zebra stripes or something.
Mm-hmm. I think that it takes time to learn what lines matter, and it takes time and experience. And if you're journaling well and you're keeping good statistics, you'll figure out that a lot of the stuff you have on your chart is absolutely useless. Most of
Yes.
the indicators are absolutely useless. Most of the lines mean absolutely nothing. You can draw as many lines as you want, and price is going to do something at one of them. The key is finding out what lines matter based on your strategy, based on your time frame, based on your right, and reducing. I've learned in the last year is that less is more. Less is more. Having, at one point it was like, am I trying to look cool or am I trying to make money?
I think some people try to look cool, man.
Yeah,
I think they're obsessed with it. Does this look cool enough?
Yeah, not to pick on Crypto Face, but he had the thing for a while with the spider lines, right? And then now the spider lines are gone. And I saw a post from him the other day, and it was like, it said it was a picture of Market Cipher, and it had the anchor wave, right? And it was like, please go up. It's like, are you begging now? Or, I mean, it's like, what is it? So your Market Cipher means nothing. Your spider lines mean nothing. I'm proud of you that you've let that go. But are you trying to look cool, or are you willing to put your money behind it, right? Is there a strategy there? So I think the lines that matter are the lines that matter. And in time, you see which ones work and which ones don't. Discard what doesn't work and go all in on what does.
Yeah, I think you said it best is, look, you have to do in order to know, right? Like, sure, we can tell you, and we did. I think we did a pretty good job today of giving everybody watching what levels matter, and then what tools do to layer on top of the levels, right? Weekly, daily, the opens, the close, the swing highs, session liquidity. That's what matters from the most. If you were going to build a house of trading, that's what you would build it on, right? That's what you would build your trading house on. Can you then throw up some walls and some posters and some other shit? Sure, but your foundation is built on that. And then you have to execute off of those, right? You have to execute off of those to know what matters, what doesn't matter, what does a bounce look like, what does a break look like. You have to, right? Because like we said at the beginning, now you got your levels. These are my levels on my screen right now. We're going to get to them, and we're going to either break, bounce, or sweep. It is your job to figure that out. It's easier said than done. Trust me, I know it is. But pick one. Pick one. Mine's sweep, right? Pick one, break, bounce, or sweep. You don't have to trade all three. You can just trade one. What do you guys think?
Man, I agree, man. Especially like we've gone through this evolution multiple times, you know, and I think it's one of the biggest things I try to teach newer traders who've only been doing this a couple of years is just put the indicators down. Like if you can't tell me what it's even doing, like when it goes this and it does this, what does that mean? And like, I don't know. I buy when it looks like that. You're not doing it right.
I've
like
been on, we got
TikTok is like the worst for this.
Dude, I just was
every
gonna
live
say.
stream is like somebody with 1,000 fucking indicators shelling some AI indicator through a group for 40
dude,
bucks.
the AI indicators on TikTok right now are insane. And what's insane is when you read the comments, these people
like,
are
yeah.
buying these things, dude.
Yeah, dude.
They're,
I'm about
and
to
they're
show
not,
one myself.
First of all, they are not AI indicators. There is no intelligence at all in any of these fucking indicators, let alone artificial intelligence. But it's
Or the
wild.
people
Like
showing them.
every other scroll on TikTok is an ad
You're like,
for
this
an
is
AI
unbelievable.
indicator.
Yeah.
Yeah, if you aren't a successful trader, make an indicator.
Right.
Make an indicator and sell it, and you will kill it. And then you can lose all the money you want, and it won't hurt. I know, and I've worked for some of the biggest phonies in the game, and they all have indicators, right? They all made indicators, and we all know why.
Because they
there's a
can't
million-
fucking trade.
We all know why there's a million indicators, because none of them work. And they're all based off of the exact same thing: volume, right? Momentum. I mean, that's
Time and
it.
price.
It's just
Time, price, volume.
I hear
just-
one more person tell me this is a leading indicator. I'm gonna punch him in the face.
yeah, leading
no, it's
you
not.
to the
It's a
leading you to
lagging.
the unemployment line. Yeah, you'll get led, right? And right now, nobody's getting their EBT payments. So yeah, yeah, it's crazy. Now that we've been doing a lot of TikTok live, and shout out to Eddie who's doing the live
Live.
trading, the real live trading. I've noticed that I never really went on TikTok, and you told me to check it out, and there are like hundreds of people watching these people
You have
who
no
don't
fucking
know
idea
what
what they're
they're
talking about.
doing.
No.
I hate to say it, I'm not an expert, but they don't know what they're doing. There was one guy who was just talking to the camera, and the caption said, "I'm a 6-figure meme coin trader." And people,
I know
and
exactly
I
what you're
put on
talking
there, I said, "Hey, you're at your computer. Can you please post your P&L?" And the chat went crazy on me. They were like, "Oh, don't come in here and be a hater, bro." And it's like, really? Like, okay, fine. And just listen to them. They had no clue on what they were doing.
Yeah,
there's a
It's
good,
wild, man.
There's a good rule of thumb there. If you look like you live in your mom's basement, you probably live in your mom's basement.
Yeah. All right. So that's drawing random lines, right? Make sure they're anchored to swings or value. You don't need to mark out. Every single candle does not need to have a mark. We told you what to do at the beginning. Do that, and you're going to be okay. That's your foundation. You can build off of that. Brian, how about this one? How about trading inside value without confirmation? So you value, you got the swing, the edges, right? How about trading within value, and you're just,
Yeah, is what you're asking me trading in a range?
So this
middle
is
range.
common mistakes. Sorry. So people like a common mistake is that traders will trade inside of value without any kind of confirmation, right? Like, dude, I'm training someone right now who had no idea even what support and resistance was, right? He would just hit buy or sell. And there's been many people like that. We're just trading in the middle of nowhere. So this is a common mistake that people have, is just trading in the middle inside of value.
Yeah, well, if you're trading in the basically you're saying you're playing the wedges, not the edges. Yeah.
Yes. Yeah.
Okay. Yeah. So internal moves, right?
Yep.
You can catch internal moves, right? If we look at the profile and it looks like a sideways triangle, right? In the middle, where there is the most volume, is the peak of that is where all the suckers are trading, right? And the edges are where the bigger traders getting involved. I can trade in the wedge, but it'd have to be like right now. Right now, Bitcoin is bouncing at the point of control. If you pull the fixed range of this whole move since the drop, it's directly at the point of control, right? It is probably the lowest probability to make money or catch a move, But if you know what you're doing, you can. But if you're a newer trader, it's so hard to have patience. Like, it is so hard to be patient, right? It's like, oh, okay, hey, well, like, Dunki says that, play the edges, not the wedges. Well, surely we got to get to one of these edges. So I'm just going to go long and catch right up there. And then it's like, what happens is that you're heartbroken by the time it arrives at a place where you should have waited to trade. Yeah, playing the inside, not suggested, but patience is key. It's very hard to be patient.
No.
What's the most common thing you can do if you play the wedges and not the edges? What do? You typically put your stop loss at the edge, and typically you get wicked out, and then typically it reverses.
I would challenge that. I would say that people who are playing in the middle of the range are not like, either their stop losses, they're doing that whole 2 to 5%, which the market loves that, right? They got that same book off of Amazon. Every big fund in the market's like, yeah, all these idiots just have 2 to 5%, so all you got to do is rip 2 to 5% and see you later. Yeah, I think that's another thing that rookie traders do, is that their stop losses are just in the middle of nowhere, just like they're taking their trades in the middle of nowhere. You asked me a question the other day, Ben, in the group. You said, when do you change your stop loss? And it's when your invalidation has changed, right?
Yeah,
if we
I agree with
come
that 100%.
and we break a level of support or break a level of resistance and flip it into support, well, then boom, my stop loss is underneath that new level of confirmed support resistance.
Yep.
I think I answered that a very long way.
No, it was good. No, it was good. Dunki, I got one for you. So how about giant moves? Like, we get, in any asset, you get big gold's fucking, I don't even know how much right now, right? But I mean, it's had big moves, big explosive moves. Bitcoin's had big explosive moves. Lots of stuff has big moves. Why do people default to fighting them, right? And I think this is a common mistake. So I guess the question isn't why do people default? You can answer that if you want, but that's the default. The default is to, I miss this giant move, I must short everything. Or I miss this giant dump, I must long every single time a 1 minute green candle appears. If, it's one of those things like, if Bitcoin pumps $5,000 off of news, don't short every single pause or assume it's an SFP. Like, trust what the charts are doing. Trust the giant news. Trust the pump until you can no longer trust it anymore. Why is the default just to, and it used to be me, right? It used to be me too.
Yeah. It's a trap you can easily get caught into, especially if you're like watching a smaller time frame.
Well,
but for, from the psychology standpoint, for me, it was, hey, look, I missed the Pico bottom and it's pumping high. I'm trying to hit that Pico top. And that's the Pico. That's the Pico. That's the Pico. And it keeps blowing you out over and over and over and over again. When those things start to happen, like if you blow a level that you were watching, you just blow through it to the upside. You got to zoom out, look at the hour, look at the 4 hour, look at the daily, wait until that next liquidity is shown to be taken out before you take the counter move or the contrarian move.
Yeah.
It's just FOMO, man. Like, look, I missed the move of the day. This is probably where it's just going to stop right here. It's just going to stop. And then it's going to go back down or it's going to go back up.
Yeah, I think Dunki said it perfectly. It's psychology, right?
Yeah.
The market, the psychology of the market. The market's a trick, right? It's like it's trying to catfish you and catch you off guard and false move and rip one way. I think that it is truly fed on playing to people's weaknesses. Surely it can't go down anymore, right?
Yeah. It won't keep going. It's got to stop here, right?
Yeah, it's got to stop here. And then, wow, look how high of that's what I used to do in the beginning of my journey. Was I used to take the measuring tool and I mean, it would be like this. It would be like at the absolute bottom, dead coin, absolutely dead. And I'd be measuring up going 6,000%. Surely I get to grab this now. It can't go down anymore.
Yeah. And then it does another
it was
100%.
just like, and people used to do that. There was a group and there was hundreds of people going, this thing's got 6,000% to the increase. And I remember it was you, Ben, who told me, you said, well, if this coin's got, 4,000% back to the all-time high, why wouldn't you just wait for a couple hundred to confirm that it's actually headed there?
Right.
Yeah.
Right.
Go visit the AMC subreddit on.
And that's what you're saying is trade with the trend.
Yeah.
If the trend is down, let it prove itself. Let it prove itself. But I think that it's impatience.
I think better.
It's
you got to make that trade back.
It's ego, it's impatience, and it's not accepting risk. Because people will talk about risk and risk management, but when they lose that money, man, then they get emotional. And when they get emotional, all bets are off, right? A fool and his money are soon parted. And emotion has no business in this game. And I think Dunki said it right, was psychology.
Yeah. I think another common mistake is, ignoring prior day levels and session timing. And that can be taken two ways. The session timing can be taken, you're not trading when people are trading. You're trading in the middle of sessions or when volumes, either on weekends, on holidays, bank holidays. And then there's session timing from a New York to a London to an Asia standpoint. And the rhythms that we have already talked about today, where we sweep it, man. Those are the trades we're looking for. And then prior day levels, right? Yesterday's high, yesterday's close. Last week's high, last week's close. Liquidity's living there, man. And it'll tell you if we're going to expand and contract or if we're going to chop within the previous day's range. And I think, how about Brian? You just did a big thing on SFPs. How about being early to SFPs, right? And I've seen this all the time. I'll see people take what looks like an SFP and price wick $30, and then they short it. It barely peaks above support and resistance, and then they'll short it, and then price comes up to do the real SFP.
Yeah.
We've seen it. I've seen it in trade recaps. I've seen it happen live trading with people in Discord. I think that's a big mistake, is being early. I
think that there is no such thing as being early to an SFP. There is no such thing, because an SFP at its core is a liquidity grab. So if you are early, you are the liquidity.
Yeah.
An SFP absolutely demands confirmation. If price swings up from a resistance level and comes back in, and it was on high volume, and you're looking at maybe delta open interest, and you could see, wow, the delta went up and the open interest went up. A lot of people long that break. And then you know what a lot of people do? A lot of people shorted that break too. But they all have one thing in common, is they are all the liquidity. So you cannot be early to an SFP. If you are the trap.
Yeah. I agree with that. It's
Yeah.
not supposed to come back, so.
How about assuming liquidity means reversal?
Yeah, a lot of times we see an SFP of an SFP, right? Or
it just means fuel, right?
And that's the thing about the market, right? It'll be done when it's done, right? It'll set the trap when it'll set the trap,
Yeah, so everything's only potential. Everything is only probabilities. I can't tell you over the course of the last however many years how many A+ SFP liquidity grabs that have happened that I've lost. Everything was perfect. Everything was perfect and lost, right? Same thing for breaks, structure, same thing for market structure shifts, support and resistance bounces, all your fancy AI algorithm tools that tell you to buy now. Everything's wrong sometimes. Even the most perfect trade can be wrong. That's why we protect our downside, right? I think that's all I got. So look, common mistakes, right? Drawing random lines not anchored to swings or value, ignoring prior day levels and session timing, trading inside value without confirmation, assuming liquidity means reversal. It's only potential. Just like anything in trading, it's probabilities. Trust the big moves. Don't default to fight. Well, I guess maybe trust the big move is the wrong way, but don't default to fighting them, right? Don't FOMO or trade out of emotions or fear. And then, like Brian said, like there's no such thing as being early to an SFP. You're either the trap or you're trading the trap. And I think that if you can eliminate and avoid these, you'll eliminate like most of rookie losses, right? Like if you figure out what lines to draw, guess what? We talked about that. If you talked about if you know your prior day levels and session timing, guess what? We talked about that. Trading inside value without confirmation. Brian talked about that. Brian and Dunki talked about the SFPs and the moves, right? We talked about the giant moves and not defaulting to fire them. Or fight them. If you can like wrap your head around those and just not do those things or do them in some of these cases, like, you know, map out your prior day's levels, I think you'll avoid a lot of mistakes, man. I know it's easier said than done. And I know a lot of people got to learn shit the hard way. But when the market teaches you a hard lesson, fucking learn from it. Listen to it, right? Don't ignore it.
I mean, this is all just telling you buy low, sell high. Everybody gets that wrong. 99% of you. Next
week. So look, today we talked about the map, where we're looking to go long or short and how to build Confluence confirmation. All tools are built on top of support and resistance. Then we talked about timeframes, right? Then we talked about days of the week. We talked about context today. So next Wednesday, we're going to talk about how to trade.
Entries?
Right? Yes, we're going to talk how to trade.
Entry confirmation.
We're not only going to talk. Look, when someone asks me when do I buy or where do I enter, I'm not impressed. I want to know. You know what I want to be asked? Where do I exit? That's what I want to be asked. So yes, we're going to talk entries. We're going to talk exits. We're going to talk stops. We're going to talk trade management. And we're going to give you the playbook. We're going to literally tell you exactly what to do. And I promise you, if you can follow I just said this to someone the other day who I don't think is going to fucking be a successful trader, because I just don't. Like, I can tell, dude. I've been doing this long enough. I know when someone's going to be successful because they're either doing the work or they're not doing the work. If you're not doing the work, you're not going to be successful. If you're not showing up, if you're not trading when you're supposed to, if you're not journaling, guess what? Pick a different hobby, right? Pick something else because it's going to be a lot cheaper. But if you can follow these 6 sheets, and they're available in Discord, they're in there. They're in the trading journal.
They're there for the premium guys.
Yeah. If you can do this and not deviate from this, you're going to be a fucking killer. I promise you're going to be a fucking killer. It's the deviators. It's the egos. It's the, I think I know better than the market. I don't have to.
It's the guys who can't drop bad habits because they think they're smarter than what we're telling them.
Yeah. And that's exactly what it is. I'm smarter than the market. I know something they don't know, or I'm going to find a shortcut. Oh, it's
I got a shortcut, guys. Drive me nuts.
I got an AI indicator, so
yeah,
have fun being broke, bitches.
And that's the thing too. Like, everyone's worried about AI taking over trading, but dude, if it's just PvP AI bot versus AI bot, who's going to be the exit liquidity?
Dude, I had
the AI bot.
I put a like a Word document, like a cheat sheet, order flow cheat sheet. I don't know if you guys saw it. I put it in the Discord the other day. Like, if price is up and delta is down, and then this and that and this. And then I asked ChatGPT, I said, can you add one more column? And it says, sure. And it added it on top. And I was like, are you fucking retarded? Like, can you please add that column to the left? It said, yeah. I was going back and forth with it. It could not do it, man. So I'm not worried about AI taking anything over, because at the end of the day, it sucks. So if you're in AI,
maybe when it like becomes AGI, like actual artificial intelligence, and can think for itself, maybe then we're fucked. But till then, I'm not worried about humans programming a language learning model. All right, guys, that's all we got today. We'll see you next week. Appreciate you all for hanging out.
Later.